Welcome to this course, A Brief History of Money, Banking, and Credit. I'm Edward J. Dodson. This is Lecture 3, titled Panic Brings Central Banking and Alternative Systems into Use. In 1891, an importer and manufacturer named Silvio Gesell brought attention to the flaws in the monetary system in a book titled Currency Reform as a Bridge to the Social State. He proposed a new kind of paper money that would have an expiration date. To avoid expiration, the bills would have to be periodically stamped. With no new stamp, they would become worthless. In this system, saving money would cost you money. Savings then would have a negative interest rate. Gesell's proposals did not attract much attention until after his death in 1930, however. Yet another financial panic in 1893 resulted in a 4-year economic contraction. Property markets in South Africa and Australia collapsed, while at the same time Argentina experienced both political chaos and failure of the nation's wheat crop. Investors started a run on gold at the U.S. Treasury, and the panic spread from there. President Grover Cleveland pushed Congress to repeal the Sherman Silver Purchase Act, which he and his advisors pointed to as a major cause of the panic. This did not prevent runs on the banks in the U.S., Britain, and in other countries. Stock prices declined in the United States, 500 banks closed, 15,000 other businesses failed, unemployment skyrocketed. By February of 1895, gold reserves in the U.S. Treasury fell to just $42 million, forcing the government to borrow $65 million in gold from J.P. Morgan and from the Rothschilds in England. The banking system and the economy limped along until the Wall Street panic of 1907. Speculative bubbles in the real estate and stock markets burst. Several long-standing New York banks failed. The unemployment rate reached 20% in the fall of 1907. Millions lost their deposits as thousands of banks collapsed across the nation. The panic ended only after J.P. Morgan intervened. Morgan personally made temporary loans to key New York banks and other financial institutions to meet depositor demands for cash until outstanding loans were repaid or securities could be sold to raise needed cash. In 1908, Senator Nelson W. Aldrich established and chaired a commission to investigate the crisis and propose future solutions. Progressive reformers responded by applying pressure on their elected representatives to come up with solutions that would hopefully prevent future financial panics. The result was the passage of the Aldrich-Vreeland Act of 1908, establishing the National Monetary Commission. Republican Senator Nelson Aldrich described the commission's charge. He wrote, "I believe, if it should be thought wise by the Commission, supported by the consensus of intelligent opinion of the people of the United States, to adopt any system, that neither the political prejudice of the past nor the ghost of Andrew Jackson will stand in the way." In November of 1910, a small group that included Nelson Aldrich and Paul Warburg traveled to the Jekyll Island Club off the coast of Georgia to work on a plan to restructure the nation's banking system. After much discussion, they decided to press for establishment of a central bank, but not a central bank under the direct control of the federal government. When the plan was eventually put before the U.S. Congress for debate, strong opposition arose from state bankers, from reformers who advocated direct issuance of currency by the Treasury, and by others who saw the legislation as nothing other than a power grab by what they saw as the money trust. Some reformers still remembered the system of mutualist banking sought in the early 19th century by the French philosopher Pierre-Joseph Proudhon. Proudhon argued that people's mutual banks would bring together the financial reserves held by the working class, making loans available to people at rates of interest they could afford, ending usury. Proudhon's ideas took form in Germany during the 1850s, as credit unions were formed as not-for-profit financial cooperatives brought into being by Friedrich Rotherhausen. Their specialty was what today is referred to as microfinance. Membership in the credit unions emphasized social solidarity and integrity. By the 1890s, there were credit unions functioning all across the European continent and in the United Kingdom. The first credit union formed in North America was in Quebec, Canada, beginning operations in January of 1901. St. Mary's Bank of Manchester, New Hampshire, was the first credit union organized in the United States, founded by French-speaking immigrants who came south from the maritime provinces of Canada in 1908. Woodrow Wilson won the Democratic Party's nomination for president in 1912, defeating Theodore Roosevelt, who ran as a progressive. In his acceptance speech, Wilson warned against the, quote, money trusts, and advised that a concentration of the control of credit may at any time become infinitely dangerous to free enterprise. Despite his statement, after taking office, Wilson signed legislation to reform the nation's currency system. The Federal Reserve was the result. The behind-the-scenes details of how the Federal Reserve System became the nation's central bank was explored by Georgetown University professor of history Carroll Quigley in his book Tragedy and Hope, published in 1969. He concluded that something deeper than a commitment to ending financial panics motivated those who pulled the financial strings of the increasingly interdependent global economy. He wrote, "The powers of financial capitalism had another far-reaching aim, nothing less than to create a world system of financial control in private hands, able to dominate the political system of each country and the economy of the world as a whole. This system was to be controlled in a feudalist fashion by the central banks of the world, acting in concert by secret agreements arrived at in frequent private meetings and conferences." Leading this effort was Montague Norman, governor of the Bank of England, described by Carroll Quigley as a strange man whose mental outlook was one of successfully suppressed hysteria or even paranoia. He had no use for governments and feared democracy. Both of these seemed to him to be threats to private banking, and thus to all that was proper and precious in human life. Strong-willed, tireless, and ruthless, he viewed his life as a kind of cloak and dagger struggle with the forces of sound money. Professor Quigley goes on to explain Norman's influence on the evolution of the financial system in the United States. Norman had a devoted colleague in Benjamin Strong, the first governor of the Federal Reserve Bank of New York. Strong became governor as the nominee of Morgan and Kuhn Loeb and Company in 1914. 2 years later, Strong met Norman for the first time, and they at once made an agreement to work in cooperation for the financial practices they both revered. The stage was set for a tsunami of financial innovations that would change the course of history. Whether these changes would be in the interest of the general population or merely accelerate the already growing concentration of income and wealth associated with monopolies of all sorts would soon become evident. In many parts of the United States, there was a high degree of fear that their financial concerns would not be addressed under the new Federal Reserve System. In one state, North Dakota, reformers organized the Nonpartisan League and in 1918 gained control of the office of governor and a majority in the state legislature. A year later, they established the Bank of North Dakota as a public bank, capitalized with $2 million. North Dakota residents suffered greatly during the years of the Great Depression. Among the reasons was the long drought that spread across the Midwestern United States. Many farmers were already deeply in debt because of dramatic price declines for agricultural commodities that occurred during the 1920s. By 1930, it cost farmers more to produce a bushel of wheat than the market price. Land prices had skyrocketed during the First World War, reaching $41 per acre in 1920. By the end of the 1930s, however, farmland in North Dakota was selling for around $13 an acre. The financial burden was intensified by the failure of local tax assessors to adjust downward the assessed value of land as the market price fell. In 1920, there were nearly 900 national and state banks operating in North Dakota, many of which were minimally capitalized. As borrowers became delinquent on loans, a growing number of these banks became insolvent and failed. By 1933, nearly 600 had closed their doors. During the Great Depression, the Bank of North Dakota experienced significant losses as well. Forced to foreclose on many farmers who could not make payments on their mortgage loans, the bank accumulated a significant amount of land in its portfolio. Most of the farmers were permitted to remain on the land as tenants, and in the 1940s, the farms were sold back to these farmers under affordable terms. More on the Bank of North Dakota and the resurgence of interest in public banks later in this course. The bankers effectively lobbied Congress to make sure the new Federal Reserve System was privately owned and not made a government agency. The Federal Reserve Act established a system of 8 to 12 mostly autonomous regional reserve banks that would be owned by commercial banks and whose actions would be coordinated by a committee appointed by the President. From inception, the Federal Reserve System has had its harsh critics, including at the time Congressman Charles Lindbergh, who argued, "The act establishes the most gigantic trust on earth. When the President signs this bill, the invisible government of the monetary power will be legalized. The greatest crime of the ages is perpetuated by this banking and currency bill." For many years, Ron Paul of Texas has called for dissolution of the Federal Reserve System. He represented the 14th Congressional District in the United States House of Representatives from 1997 until 2013. On the question of what ought to be done with the Federal Reserve System, he wrote, "Since the creation of the Federal Reserve, middle and working class Americans have been victimized by a boom and bust monetary policy. In addition, most Americans have suffered a steadily eroding purchasing power because of the Federal Reserve's inflationary policies. This represents a real, if hidden, tax imposed on the American people." Representative Paul and other critics argue that the Federal Reserve System has failed in its two primary responsibilities: to mitigate the boom-to-bust economic cycles that have continued throughout its existence, and to preserve the purchasing power of the nation's currency. If your dollar income is increasing at a rate greater than the rate of increase of the cost of what you are consuming, you are keeping ahead of inflation. For a majority of households in the United States, the opposite has occurred since the late 1970s. As widely discussed, our society has experienced an accelerating concentration of income and wealth as shown here. The underlying question is whether this outcome comes from real contributions to economic production of goods and services or from what in economics is referred to as rent-seeking, privileges under our systems of law, taxation, and public policy. Note the continuous rise of income within the top quintile, or 1/5 of income earners. The Federal Reserve reported earlier this year that the net worth held by the top 0.1% of U.S. households had climbed from $12 trillion in 2020 to $21 trillion today. A reasonable question to ask is just how much of this increase is earned by its recipients. As the history of the last century reveals, the very outcomes the Federal Reserve System was created to prevent have repeatedly occurred. Based on this historical experience, one might reasonably conclude that even the most efficiently operated system of money creation can prevent neither the credit-fueled, speculation-driven booms or the recession/depression crashes that follow, or the system put into place by the passage of the Federal Reserve Act was the wrong solution. It is important to understand that the final structure of the Federal Reserve involves significant compromises pushed for by the nation's leading bankers who sought the creation of a fully private central bank. Initially, the issuance of currency remained with the U.S. Treasury, which produced gold certificates, silver certificates, and United States notes. However, in 1914, the Federal Reserve banks began issuing Federal Reserve notes as legal tender for satisfying debts and for payment of taxes. In 1921, Senator Robert Owen, who co-sponsored the Federal Reserve Act, charged that the Federal Reserve Board had abdicated its responsibilities in favor of the bankers. Owen argued against private control of what he believed should be a public utility banking system. Notably, Owen actively campaigned in 1908 for the election of William Jennings Bryan to the presidency. Of Owen's position, one historian writes, Owen and others viewed price stability and moderate interest rates as key objectives, while most other early Fed leaders preferred to focus on maintaining the international gold standard and the strength of the banking system. To the political leaders of most nations, national wealth was still measured by the quantity of gold bullion held in government vaults. When the gold stocks were increasing, this told them the nation's balance of trade was favorable. The economy is healthy when, by definition, the value of goods exported was greater than the value of goods imported. Thus, when a country experienced a trade deficit, it experienced an outflow of gold, causing an increase in the price of imported goods because there was less gold available to repurchase currency balances the other country now held. The structure of the gold standard meant that governments could not arbitrarily increase or decrease the nation's currency supply. Moreover, linking the money supply to gold prevented governments from effective intervention during periods of rising unemployment, when making credit widely available at low cost was needed to stimulate the production of goods and services. The outbreak of war in 1914 caused countries to suspend gold exports and enact laws restricting the private gold market. Rather than increasing taxes on those with the greatest ability to pay and who had the most to lose in the event of defeat, governments sold bonds to raise revenue. And when that proved insufficient, they simply printed currency, no longer concerned this would result in a loss of gold reserves. As always occurs during war, prices increased and governments pursued domestic priorities over global monetary cooperation. For the people of the United States, the end of war left the nation with the challenge of demobilization. Some 3.5 million Americans were in military service. This generation of young adults has been referred to as, quote, the lost generation. Millions moved into the nation's cities, increasing the demand for housing and challenging the capacity of city governments to meet not only the demand for housing, but for education, medical care, and other public services. Back in 1904, the journalist Lincoln Steffens traveled across the United States, reporting on the conditions he found in the nation's major industrial cities. What he reported on was a consistent pattern of corruption and power grabbing. What he wrote about Pittsburgh applies broadly. Businessmen came almost as cheap as politicians, and they came also at the city's expense. The boss had control of public funds and the choice of depositories. That is enough for the average banker, not only for him that is chosen, but for him also that may someday hope to be chosen, and the boss dealt with the best of those in Pittsburgh. The boss was a man named Christopher L. McGee, who served as city treasurer and developed a plan to ensure he would pull the strings behind the scenes. As Lincoln Steffens wrote, Boss McGee's idea was not to corrupt the city government, but to be it, not to hire votes in councils, but to own councilmen. And so, having seized control of his organization, he nominated cheap or dependent men for the select and common councils. Relatives and friends were his first recourse. Then came bartenders, saloon keepers, liquor dealers, and others allied to the vices, who were subject to police regulation and dependent in a business way upon the maladministration of law. Many Americans blamed the liberal immigration policies on the deteriorating conditions in the nation's cities. The success of the Bolshevik Revolution in Russia also intensified a commitment to protect the American system from foreign influences. The Immigration Act of 1924 was the result, setting maximum quotas on immigration based on the country of origin. Following the end of the war, inflation ate away at household incomes, and workers responded with strikes and lockouts. It took until 1923 for the United States economy to begin a new expansion. Farmers, who had expanded production by taking on new debt during the war, now faced serious problems servicing their debt as commodity prices fell. Reform-minded individuals such as Ralph Borsodi began writing and teaching about the problems of urbanized society. In the 1920s, he moved his family to the first of several rural homesteads in search of a simpler and more stable existence. His observations were eventually detailed in two books, This Ugly Civilization, published in 1929, and Flight from the City, published in 1933. In these books and others to come, Borsodi argued for a return to self-sufficiency. Eventually, he would turn his attention to money issuance. Late in life, Borsodi started an experimental program in his community of Exeter, New Hampshire. The local bank agreed to accept deposits and act as a money changer. Borsodi issued notes called constants in exchange for Federal Reserve notes deposited with the bank. The value of these constants was based on a basket of commodities and an index of the commodities. Many people bought the constant notes and made deposits in the bank checking account. The constants began to circulate in the town where restaurants and other businesses accepted them as payment. Borsodi invested the dollars in silver and other commodities. In this way, the constants were protected from inflation. Individuals and local businesses joined the system, thereby keeping purchasing power within the Exeter community instead of spending dollars that would leave never to return. Robert Swan, a close collaborator of Borsodi over many decades and founder of the E.F. Schumacher Society, offered his assessment of Borsodi's experiment with constants as a local currency. Swan wrote, "In an objective evaluation of the Exeter experiment, it seemed to me that several aspects of the experiment had been developed successfully and could be duplicated elsewhere. One of these was the strategy of utilizing small local banks as the administrative agent for starting a new monetary system." As Borsodi often pointed out, local banks are not the problem in themselves. The problem is that they have to deal with dollars only, and the issuing of dollars is a monopoly of the centralized government-controlled system. Local banks provide an important and needed service in accepting deposits, making loans, keeping accounts, and collecting payments on loans. However, as historian Frederick Lewis Allen described the situation in his 1932 book Only Yesterday, the nation was moving at breakneck speed toward industrialization, large-scale commercial agribusiness, and urbanization. The growth in the ownership of automobiles during the 1920s signaled the transformation. The interurban trolley perished, or survived only as a pathetic anachronism. Railroad after railroad gave up its branch lines, or saw its revenues slowly dwindling under the competition of mammoth interurban buses and trucks snorting along six-lane concrete highways. The whole country was covered with a network of passenger bus lines. In thousands of towns, at the beginning of the decade, a single traffic officer at the junction of Main Street and Central Street had been sufficient for the control of traffic. By the end of the decade, what a difference. Red and green lights, blinkers, one-way streets, boulevard stops, stringent and yet more stringent parking ordinances. And still a shining flow of traffic that backed up for blocks along Main Street every Saturday and Sunday afternoon. Slowly but surely, the age of steam was yielding to the gasoline age. There were other problems obscured by this tremendous increase in the sale of automobiles, radios, and other consumer products. Frederick Lewis Allen understood what was happening as few others did at the time. Prosperity was assisted by two stimulants to purchasing, each of which mortgaged the future but kept the factories roaring while it was being injected. The first was the increase in installment buying. The other stimulant was stock market speculation. When stocks were skyrocketing in 1928 and 1929, it is probable that hundreds of thousands of people were buying goods with money which represented essentially a gamble on the business profits of the 1930s. In this brave new world of financial and economic innovation, economists around the world weighed in on the risks, offered a range of views on how public policies were supported or not supported by economic theory. Leaders from 34 nations met at Genoa, Italy in 1922 to address the problems of rebuilding a defeated Germany and the countries of Eastern Europe. The one policy all agreed upon was to resume the gold standard. In 1924, Winston Churchill was appointed by Stanley Baldwin as Britain's new Chancellor of the Exchequer. Leading economists and officials at the Bank of England urged him to return Britain to the gold standard at the pre-war parity. In 1925, he defended the decision. In carrying out a great change like the return to the gold standard, it has been necessary to move with extreme care. So many objects have to be kept in view at the same moment that delicacy and judgment are required at every step. I think that in the Treasury and in the Bank of England, we have the most skillful advisors and financiers that any country can show. At any rate, they are respected all over the world, so there is no reason why they should be looked down upon at home. Britain's real economy, meaning the capacity to produce housing and other consumer goods and provide needed services, had not recovered from the war. A growing trade deficit caused a drain on Britain's gold stock, forcing Britain in 1931 to seize the use of gold to settle accounts. Many other countries followed for similar reasons. The United States merely increased the price of gold from $20 an ounce to $35 to slow the loss of its gold stocks. Churchill explained to his countrymen why he believed the policies of the United States were preventing global economic recovery. The unwholesome accumulation of gold in the only two countries which benefit from those uneconomic and non-commercial payments of war debts has largely paralyzed world credit, checked the flow of trade, paralyzed prices, especially the prices of prime commodities, and has made it impossible for millions of workers on both sides of the Atlantic to earn their daily bread. Partly, perhaps because he has no instinctive judgment to prevent him from making mistakes, partly because lacking this instinctive judgment, Partly, perhaps because he has no instinctive judgment to prevent him from making mistakes, partly because, lacking this instinctive judgment, he was deafened by the clamorous voices of conventional finance, and most of all, because he was gravely misled by his experts. More attention should have been paid to the insights of a young economics professor named Harry Gunnison Brown, who earned his doctorate at Yale University and came out with his first book in 1914, International Trade and Exchange, in which he warned against the resort to protective tariffs in an effort to achieve a positive balance of trade. Brown wrote, "The first effect of protection is to raise the prices of protected goods by not more than the amount of the tariff without affecting money wages. The secondary effect of protection, resulting from the inflow of money, so far as protection occasions such an inflow, is to raise prices of unprotected goods and money wages, and to further raise the prices of protected goods." Looking back on the 1920s, Frederick Lewis Allen examined the many different market segments operating in the United States. The one consistent element he found was constant and intense speculation. This behavior was, he concluded, greatly facilitated by the actions of the nation's central bank. In the mid-1920s, the first warning sign that all was not well occurred with collapse of the Florida land boom. Other land booms turned south as well, and an increasing number of local and regional banks failed. And then, as investors shifted their funds to the stock market, another asset bubble became inevitable. Throughout 1927, speculation had been increasing. The amount of money loaned to brokers to carry margin accounts for traders had risen during the year from $2.8 billion to $3.6 billion, a huge increase. During the week of December 3rd, 1927, more shares of stock had changed hands than in any previous week in the whole history of the New York Stock Exchange. The speculative fever had been intensified by the action of the Federal Reserve System in lowering the rediscount rate from 4% to 3.5% in August 1927 and purchasing government securities in the open market. While stock prices had been climbing, business activity had been undeniably subsiding. The so-called Roaring Twenties was coming to an end. The reformers had tried and failed to bring about the changes in law and public policy they believed were necessary to prevent yet another period of economic contraction and financial panic. There was growing concern about what was to come. And with that, we reach the end of Lecture 3.